you're going to go through how you actually record in your journals these payments of the taxes that you're making to the government. So kind of to start out with, just a little bit more, employers have to pay those federal, state, and local governments, all those payroll taxes that you've withheld. When you make those payments into the government, they call that a deposit. And this thing called the lookback period is the 12-month period that ends on June 30th of the prior year. And that determines how often you have to make those payments into the government. And there's this whole chart here of what needs to go in. And I'm going to go through this a little bit quickly, and you can just kind of look at it in the textbook and read through it. It's just a series of questions, and you answer yes or no, and then it determines whether or not you're a semi-weekly depositor, a monthly depositor, or how that works. And again, you can look through that and read through that on your own, because I think there are some questions on the study guide and stuff about those. In this book, we're using 3 Green, and they are going to be a monthly depositor. So that's what we're going to use as our practice. So a couple of things on that, though. New employers, if you don't have that 12-month look-back period, are always going to be monthly. That's just what they do until the look-back period has been established. Those tax deposits have to be paid electronically. They can be done straight from the bank. And you have to keep up on what the new tax rules are, because tax rules are changing every year. And so, if you have a person, if you're an accountant or CPA, those are things that you will keep up with on a weekly or yearly basis anyway. So to journalize that payment, this is just kind of what we did in the last section. But now we're going to actually be sending that money into the government. And so as we've gone through in the past, all that money's been taken out of payroll and put into these liability accounts. And now we're going to take the money from the liability accounts and pay it to the government. So the transaction says paid cash for liability for employee income tax, gives you the amount, Social Security tax, and Medicare for the total amount. So when we did these payrolls, you did a payroll on the 15th and a payroll on the 31st, and that money was put into these payable accounts, these liabilities, as you did that payroll. So now all we're doing is looking at them and seeing how much we put in there in December, which was a total of $998 in employee income tax payable. And we're going to take that money out of there. So if a liability account has a credit balance, to take that money out, you're going to debit it. So all of these liability accounts are going to be debited. So employee income tax payable, debited, Social Security tax, Medicare tax payable, and the credit is to cash because it's coming out of your bank account. So if you look at these T accounts here, and then go to the next one where it's journalized, that's how you journalize it. That's probably the easiest part of all of this, because all of the figuring of how much the taxes are and all that kind of stuff has already been done up to this point. You also have to pay your FUTA and your Pseudo taxes. So a couple sections back, and even in chapter 12, we talked about the FUTA tax, which is federal unemployment tax, and Pseudo, which is state unemployment tax. And so we also have to now pull that out of that liability account paid into the government. So FUTA taxes are paid by the end of the month following each quarter. If the liability amount is more than $500, unemployment tax liabilities are done at the end of the year. So just the federal. And then it's also paid to the federal government using electronic funds transfer. So that transaction is going to be paid cash to federal unemployment tax liability for quarter ended December 31st. Again, you'll just go back to your journal, your ledger, and you'll see how much money was put in there, the balance on November 30th, and how much was put in there. And you're going to then, because it's a credit balance, because it's a liability, you're going to debit it and then cash. So that one's pretty easy. And then the one for state unemployment tax is the same thing, just to unemployment tax payable state. And that wraps up the 2 chapters on taxes, which are probably 2 of the more difficult chapters that you're going to go through this year.